This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going
capitalists to athletes to creators
mainstream.
to the person who
Going mainstream.
is a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode is one of evergreen importance. We talk with one of the pioneers in the evergreen fund space, Rob Collins, a partner, co-head of private wealth, and head of the New York office and a member of the global executive board at Partners Group, a $147 billion AUM alternative asset manager, joins Alt Goes Mainstream to discuss how Partners Group started the evergreen space in the early 2000s. Rob has deeply evolved perspectives on both evergreen funds and working with the wealth channel. He leads Partners Group's U.S. private wealth and defined contribution practice and is president, portfolio manager, and member of the board of managers of Partners Group Private Equity Master Fund, LLC. He also chairs Partners Group's U.S. Investment Committee. He joined the firm in 2005, only 4 years after Partners Group was the first firm to launch an evergreen private equity structure. Rob and I had a fascinating conversation about what evergreen funds are, the mechanics of how they work, and why they can make sense for investors, both individual and institutions. We discussed what Partners Group saw in the early 2000s that made them decide to create evergreen private equity fund structures, why it's taken the industry time to adopt evergreen funds, how to think about returns with evergreen funds, why institutions, in addition to wealth advisors, have and are using evergreen funds, why the time, money, and liability questions of private equity fund investments make evergreens a fit for many advisors, the importance of compounding and how it relates to evergreen funds, the challenges and nuances with managing evergreen funds, why life is too short for capital calls, how private equity can go from being sold to being bought, and what the industry can do to remove pain points for the wealth channel. Thanks, Rob, for coming on the show to share your thoughts and wisdom on private markets and the importance of one of the biggest trends in private markets, evergreen funds. We hope you enjoy. Rob, welcome to the Alt Goes Mainstream podcast.
Great to be here, Michael. Thank you.
Great to see you. Pleasure to have you, especially given all the work that you've done around evergreen structures and really transforming private markets over the last 24 years almost. Would love to hear from the early days of Partners Group. Take us back there. What was that like?
Some things have changed. Some things are very much the same. What's changed is we're a bit larger. Like any firm that's been in this industry for the past couple of decades, we benefited from the growth of private markets. When I joined, we had about 100 people. I was the first local experienced hire in New York. We've grown to now about 1,900 people and 20 offices around the world. A little bit larger, but what hasn't changed is the DNA of the firm, still very much focused on listening to clients, creating solutions for whatever challenges or opportunities or problems that they have. What hasn't changed is we feel like we've always been a little bit different. Today's topic is one example of that. We've built the firm, operated the firm. I look at the breadth of our investment engine, the types of things that we were doing back then and still doing today, now growing that engine. And I think one thread through the history of the firm is innovation. If you are listening to clients and you are in a dynamic industry and you're trying to help those clients achieve their objectives, solve their problems, whatever it is, that tends to come with innovation. Evergreens is one example of that. Going public at a very early stage, that was innovative. Some things haven't changed, some things have, but it's been a great place to be.
If we go back to 2001, what were the conversations back then and what compelled you to start evergreen structures for your clients?
It was a frustration that clients had with the structures and solutions that were available for private markets. The 10 or 12-year limited partnership that is a commitment vehicle and not an investment vehicle is just really incompatible with many investors. It was for a European institutional investor who wasn't able to get access, get exposure to private markets using commingled funds. I know we're very well known for our US solution, which we started working on in 2007. In this case, a US multifamily office who said, look, we understand private equity. We like it. We want to have more of it. But when it comes to building a thoughtful portfolio for multi-generational families, there are a number of challenges that come with that traditional limited partnership. What we did was try to innovate, try to do something about it, leverage the capabilities that we have. Whenever we're approached with a client situation where they have that challenge, have that opportunity, have that frustration, we say, okay, what can we do about it? And do we have conviction that we can provide that solution? And as it relates to evergreen funds, we had that conviction because we felt like and still believe today strongly that we have the right investment engine, the right operational capabilities, the right organizational structure to try to innovate and provide those solutions.
Was the reason why you built evergreen structures back then, does that same framework and concept hold today?
Absolutely does. From the client perspective, it's how do I get exposure? How do I get in? How do I get invested? I think there's become a growing awareness that the economy has been shifting from public to private. I think there's a growing understanding from the private equity perspective, equities are equities. So, how do I get access to those companies, those promising companies that may have been public or may never? How do I get that with consistency? How do I get that in a way that it doesn't drive me crazy? So, this flexibility, the simplicity of the evergreen solution is really powerful. And we hear it all the time today. Most of our engagement is with financial advisors. I think that's probably true for most firms like us. And from their perspective, it's becoming more and more appealing. I'll give you one example, Michael. We had one of our recent academies where we bring in financial advisors to our beautiful campus in Colorado. We had a panel discussion, and one of the panelists, a financial advisor, said, think about it. It's time, money, liability. I'm running a business. I'm a financial advisor. My team and I are responsible for these families. Time, money, liability. And I said, please expand on that. And he said, we only have so much time. We have to do wealth planning, estate planning. We only have so much time to serve our clients. And commingled funds are really difficult. Forecasting the calls, the distributions, managing the J curve, your exposures is just really challenging. And then money, we don't have endless pools of capital or resources to build teams to help us do that. And then the liability, this one was fascinating to me. He said, I'm a part-time arbitrator for FINRA. When I'm not managing my clients' assets, I'm arbitrating cases. And half of the cases I see involve some kind of a mistake with a capital call or a distribution. The point was, I can do private markets in a way that are just as effective and they're easier for me as an advisor or a team of advisors. So yes, Michael, this category, the adoption of evergreen solutions, I would argue is accelerating now, and we continue to see it as a critical part of a portfolio.
When you list out those reasons for why an investor may want to have access to an evergreen, whether it's the financial advisor or the end client, why do you think it's taken the industry so long to adopt evergreen structures?
Well, I guess the economists would call it an installed base problem. You had a installed base, or you had a industry and or structure that was built around these limited partnerships. And there's a consensus that this is the only way to do it. This was reinforced by all of the organizations involved in our industry, whether that's CFA or Kaya. There was almost a mentality, no pain, no gain. If I'm doing private markets, it's painful and it's hard, but it's worthwhile in the end. We're proud of our role saying, look, you can get the same result. I would even argue a better result in terms of that investment outcome while taking away a lot of that pain. We really led the charge there, and I think it took some time for us to prove the doubters, to actually generate the results, generate the factual data. Yes, you can do it. You can get the outcome for your client, the investment outcome, and take away that noise. That took a while. That was the first number of years. The questions we were getting was, why isn't anyone else doing it? Then we started to have some of our friends join in this journey. These funds are not easy to do correctly. I think it does take time for firms to really understand how to do it, to develop the resources that they need to have to do it well. But that eventually happened, as it happens in any industry. In the last 5 years, really accelerated. We've called it an evergreen fund frenzy in terms of the number of firms and the new products being launched by firms focused on evergreen.
On that point, how much do you think the industry, particularly the LP side, as well as the GP side to some extent, because they probably needed to see whether or not this actually worked, but how long do you think the industry needed to see whether or not performance actually played out? You had this great chart that you put together. It was in a Cleary Gottlieb white paper as well that shows the comparison of returns between evergreen and closed-end funds over a 10-year period. There's obviously, I think, some considerations around it too. Like if it's a closed-end fund, you're either leaving your uncalled capital in the MSCI or uncalled capital in cash, and that shows a difference in return as well. But the returns with an evergreen fund were significantly greater than either closed end with uncalled capital in the MSCI or closed end with uncalled capital in cash. Do you think that that played a big role in the adoption? You also have another great chart in one of your demystifying private markets white papers where it shows the launch of evergreen funds in private equity from 2001 to 2013. I think you were the only firm launching evergreens. So maybe it took that kind of time to really be able to show the space that this is how it works.
You're right. It does take time. And that chart was one of the tactics, frankly, we used. So I think it was 5, maybe 7 years ago. We said, look, let's provide some of the theory, if you will. We said, what does it take to generate that final TVPI, that final multiple that people are looking for as it relates to, private equity? And what is the net IRR that gets to that multiple? Also, what is the time-weighted return of a fully invested fund? I call it the translation slide. How do you translate IRRs into time-weighted returns? We needed to do that for exactly the reasons you highlighted to really provide that framework. This is how you can get to that same outcome. And again, I think it's a better outcome. And this is how you should really think about IRRs in the context of time-weighted returns. So combining that theory, if you will, with the actual results, I think it took about probably 5 years. So when I look back to sort of the mid-teens, that's when we started to have more institutional adoption of our evergreen strategy. The institutions would say, yes, you've proven that you can consistently get this attractive net return with these structures. Attractive meaning as good or better than your Cambridge or Burgess or whatever the benchmark is you're looking at. And it gets to compounding. So the most important thing, Mr. Munger would say, first rule of compounding, never interrupt it unnecessarily. This is what it's about. If you're compounding with an evergreen fund, consistently, it is extremely attractive relative to that commingled fund. So we provided that framework. I think as more and more of our peers have done their own analyses supporting that, I think that story's now becoming much better known, and it enables people to say, okay, here's how I can use these evergreen funds. Maybe it's not the only thing I should be doing, but I should think about this as part of my portfolio. I'm getting invested, I'm staying invested, I'm still going to use drawdown funds, but it just helps people make that decision, if you will.
I want to unpack something you said in there, which is so important, which is around compounding. You're quoting Munger saying, never interrupt compounding unnecessarily. How does that impact the way that investors have allocated to private markets? Because in some ways, just want to keep that money in there. Maybe you add a little bit over time. And in theory, you could technically take some out as well, given some of the liquidity features these evergreen structures have. But has it changed the way that investors approach their exposures to private markets because of an evergreen structure versus a drawdown structure? Would they just make that one allocation and let it compound? Would they add over time and then think about how much exposure they have? Would that change because of the compounding?
I think it has enabled individual investors, institutional investors to rethink how they can manage their private markets portfolio, because you can now manage your exposure with greater precision and with greater control. We do think it's opened some eyes in terms of what you can do with your portfolio. Michael, I often talk about my dad because he put the first 50,000 in our US flagship fund. And for him, it's perfect because he's not a QP. He's done fine. He's saved. He's done everything right in his life, but he needs one single solution. Here he can get it 50,000, get a diversified evergreen portfolio, and he's invested, he's in the private equity market. These evergreen funds, I think most people think about it for that case. On the institutional side, it's if we leave aside the recent experience of denominator effect maybe 18 months ago, if we look over the long run, the institutional challenge is how do I get the money in the ground? And for decades, it's been okay. I'm trying to get from 5 to 8 to 10 to 12 to 15% invested. And it's really hard when I'm not investing, but I'm committing. So for the institutions, it does enable them maybe to have more of that core and that proverbial core satellite framework. They can use that with an evergreen fund. And provided that evergreen fund manager is executing his or her responsibility of keeping it invested and compounding that, they can get that core exposure and then around the periphery, still use those drawdown funds because there are many strategies that may not be compatible with evergreen where you want to have that exposure. So we think it's very much a symbiotic relationship with these evergreen funds and drawdown funds.
Walk me through the investing psychology of someone like your dad. I imagine there's a lot of accredited investors, even qualified purchasers, who may want to put 50,000, 100,000, a few 100,000 into an evergreen structure. Is that the only allocation they're making to an evergreen structure, or are they then continuing to allocate over time? Are they saying, you know what, I'm fully invested day one capital call, I'm in, and I have exposure, that's good enough, and I'm just going to let that grow?
We certainly see quite a bit of that. That's what my dad has done. He puts it in his IRA account and then it just compounds. We have others that will sometimes add more, but it does enable them to have that simple solution. You get invested, again, provided the manager is, we think, doing the right thing. You keep that client invested, you're compounding over the long run. And then, by the way, we haven't really gone into all of those pain points, but things like 1099, no J curve really make the experience a positive one. So we tend to see a bit more of the buy and hold. We have some investors that will add over time. They can do that dollar cost averaging themselves rather than committing to a fund. They can say, okay, I'm going to add these additional allocations over time. So we certainly see that. And I think one of the future trends is that you're going to have, again, maybe not every single strategy, but you have more choice. And we've seen it already, more choice in these evergreen strategies in terms of, okay, I just want private equity, or maybe I want some private infrastructure. or maybe I want more of this kind of equity, and of course, real estate and credit. But for that mass affluent, the evergreen is just incredibly powerful because you may not have the ability to have hundreds of thousands of dollars invest in these funds. So to be able to get a massively diversified solution that compounds is really powerful in helping those investors get the exposure. And what we observe is many of them are attuned to the broader trends. You can't help but pick up the journal or the FT or go online and realize that the markets are moving public to private. And there are these terrific companies that you can only get in the private markets. And these evergreen funds look and feel, and many cases are mutual funds, and they're familiar with that construct.
I think you're bringing up another really interesting point, which is getting invested right away. In the current time, people have talked about, particularly in categories like private equity or venture, as multiples have gone down, in part due to higher rates. These have been more attractive times to buy if you're in private equity or venture. How much interest has there been now in investing in certain evergreen strategies like private equity because of the current time frame and people saying, you know what, I can get invested now rather than over a 3-year period with a closed-end fund where I may get some good years within that vintage, but I may get some maybe not as great years.
We see that. I think that is another advantage of these solutions. And that's number one for us. When we talk about evergreen, it's that you're getting invested. You can decide when you want to get invested rather than outsourcing that decision as an LP committing to a fund. You can decide. So we certainly see investors saying now it feels like a great time to invest. So we're going to add more. And you've never had the ability to do that. We certainly see that as the key appeal of these solutions. Get invested, stay invested. That's what it's all about. That's the positioning we really stand for. I think the other thing 20 years ago, 30 years ago, all you would hear was all you have to do is pick the best manager. And we've always said, look, that's very true. You need to pick a manager with experience, but you also have to think about private equity, private markets, similar to public markets, in that this is a heterogeneous marketplace. The values are changing. So this relative value philosophy or tactical asset allocation is critically important because there's some years where, as you're saying now, purchase prices may be lower and better in buyouts. There's some years where maybe you want to lean into venture capital. There's some years where you want to do more in secondaries. When we started our US fund, all we did was secondaries, basically, in the middle of and coming out of the financial crisis. The right manager is important. Relative value is important. Getting invested. And by the way, pick the right investments. So that investment selectivity, portfolio construction flexibility, this is really what you need to have. And back to your prior question, why did it take time for the industry to develop new solutions? Not so easy to do all of that with a great deal of consistency over time.
You talk about the ingredients that it takes to make an evergreen fund successful. Are there certain skill sets required to manage an evergreen fund that are different from a closed-end fund, or is it relatively similar, just the structure for how you take in capital and maybe even deploy it to some extent is different?
There's some significant critical differences, I would say. If you think about the responsibility a manager has with an evergreen fund, it's not a 3-year investment period, a 4-year investment period. I call it an infinite responsibility. We're being entrusted for decades with this capital. So we have to have the flexibility and the scale and the discipline to do that. We're taking in capital on a regular basis, and we have to be able to put that capital to work in the right part of the market every minute, every hour, every day, every week, every month. We have to be thinking about what's the best use of those dollars that are coming from clients or coming off the existing portfolio, and then to diversify that, to keep it invested, diversified consistently through time. That's not for every fund manager. So you need to have flexible investment engine. You need to marry that investment acumen in terms of selecting the right companies, the right assets with portfolio management. capabilities, which you didn't really have to deal with a commingled fund. You need to tackle all of the operational considerations, whether that's valuation policy or just capital flows, enormous differences. I think that's why you've seen many of the earlier movers have come from the larger platforms that have the resources, the capabilities to invest in the business to build out maybe the missing capability here or there that they need to have in order to deliver an evergreen fund.
So many interesting things to unpack in there. I'll start with one around investment selection. So I can understand on the back end around exit, you may have a different time horizon or less pressure than a closed end fund to sell at the end of the fund's life, which may make the decision at exit different or how you get liquidity different. How does that then reference back to the investment selection? Does that change the way that your investment team is thinking about the types of businesses you invest in? Maybe there's a different time horizon you're okay with. Maybe it doesn't have to be as much of a fast grower in the first 5 years, but if it is in 20 years, then it's worth doing. How has the structure changed and informed the way you invest?
Great question. And this is maybe where I would refer to our brand of built differently. We've always had this pro rata allocation of investment opportunities. When we created these evergreen funds, we didn't really have to change the investment engine. This is just another client, so to speak, another pool of capital that will invest alongside our commingled funds or institutional separately managed accounts. We're just taking another bite at the apple with everybody else, but on an equal basis. So the underlying ingredients are coming from those same investment teams. So the control buyouts that we're doing, equity co-investments, the direct lending that we're doing, the secondaries, it's the same exact content that you would find in our other pools of capital. And then it's just put together specifically for the investors in this Evergreen 40 Act fund in the case of our US solution. That's where it gets a little bit different. We have the same teams. So across those individual strategies, we have those investment teams, but then we have a separate portfolio management team, which also we've had for decades. Here are the people looking for the right investments, and then here's a separate team that's responsible for building the portfolios for those clients. And where sometimes we have to have a divergence, you pointed out at exit, we may have some companies that, back to Munger and Buffett, we have some companies that have that proverbial moat. And we say, why would we ever sell? And for the pools of capital, our drawdown funds that just have to sell, they can do that. And then for our evergreen solutions, they'll continue to hold if it makes sense to do that. If we can see those returns through that underwriting, the next underwriting, if we can still see the opportunity to generate those private equity returns, we'll keep them. So we've benefited from all of the resources, all those investment teams. We have this differentiation around allocation and putting that all together into portfolios that drive that evergreen solution. That's how we do it.
One question there that comes to mind on the point of exit, because you mentioned you can hold these businesses for longer if you so choose, and that evergreen structure allows for that. We're seeing this rise in the popularity of continuation vehicles. This is obviously for closed-end funds who want to continue to hold on to assets that they believe are fantastic assets to hold on to and want to continue generating fees on one hand, but also providing investors with the opportunity to continue onward with that journey without having to sell. Do you think the rise in evergreen structures amongst some of these funds that may also be doing continuation vehicles with some of their closed-end funds, do you think that impacts the CV market at all?
It could. I think these evergreen funds, there's a lot of attention as there should be on them, but as a proportion of the total industry assets, still rather small. But I think conceptually, yes, I would agree in that the continuation solution is there because of that finite light of the limited partnership. And if the evergreen funds continue to take share from commingled structures, from drawdown funds, yes, maybe you wouldn't need to have as many of those continuation fund solutions in the future.
We've talked about a lot of the positives of evergreens, and there are clearly a number of them. I want to talk about the concerns and risks. What, in your mind, are the challenges with evergreen structures, both from a GP perspective as well as an LP perspective?
From a GP perspective, these are complex, not easy to run these evergreen solutions because getting invested, staying invested, being diversified through time, it's difficult to do. So, from the GP perspective, you need to have a ton of resources to do this. And we would argue to do it in a way that you are controlling for risks. For example, we feel strongly that you need to be diversified across multiple dimensions. You need to have diversification of those idiosyncratic risks. So, position size limits, for example, you need to diversify through time, vintage year risk, and you need to have a high investment level at the same time, or else you're not providing that outcome. The challenge is that's really hard to do because you can have temptation to grow too quickly, and then you have to limit one of those constraints. We've seen that you need to have an appropriate approach to growth, which can be difficult decisions for any investment management firm to make, to say, no, we need to slow down because if we're raising too much capital, that may impugn the portfolio construction.
How do you think about that, especially now as a public company? I looked at one of your investor presentations. You have incredibly steady management fee margin, which people obviously like in public markets. You have size and scale as a business. So continuing to grow AUM would incentivize the employees to grow the business for the stock price appreciation. But at the same time, that may impact investment performance. And obviously, over time, then you may lose LPs. So understand why you wouldn't want to do that. But how do you think about that balance and interplay? Because it is also a finite game, right? There's only so much wallet share that every firm is competing for. And if you don't get it and someone else does, then maybe they can cross sell and get that LP to buy another one of their products. So that really does matter to be able to get an investor on your platform when you want to.
Yeah, well, maybe I'll start with the second part of that first. I think we have benefited from the fact that this is a growing marketplace, meaning the private wealth market relative to the institutional market. There's a lot of growth, and therefore there's a ton of room for many firms to be successful, and many have been successful so far. That's, I think, one distinction to the institutional market. And then to the first part of the question, these are hard decisions. What we've done, we've said we really need to think long term. Yes, you have to be there to capture those flows, but you're not doing yourself any favors if you capture the flows and then have a bad outcome. That's actually the worst thing you can do. So our focus has been, what is the long-term outcome? How can we drive the results for our clients? And if we do that, we will build a powerful business over the long term. So by doing that, everything we've been talking about, getting invested, staying invested, avoiding mistakes. What's the other second most important thing after compounding and time in the market is avoiding mistakes, right? Back to the Buffett Munger discussion. And that's what the diversification is about. We don't control the universe. So let's be diversified. And the challenge, Michael, is okay, if you're doing that, you may get to a point in time when there's a great deal of interest in your firm and a great deal of interest in your product, and people want to give you more money. And you just have to do the right thing. It sounds crazy, but 5 years ago, I was chastised by our board of directors. Rob, you're starting to run the risk of growing too quickly. And so we had to go into the no business. We had to say no to new platforms. We had to say no to institutional investors because our North Star was high investment level, diversified, great content, no exceptions. Those are difficult discussions. That puts some stress on your sales team because they're incentivized to raise assets. This is the challenge. Growing marketplace, a lot of interest. If you have a track record, but you really have to just do the right thing and control the rate of the growth. It's not the overall size, it's the rate of the growth. of our business. That's what we really focus on. And then everything else. You look at our headcount to our AUM, it's a R square of one, as I call it. It's a linear relationship, more assets, more people. There's not a ton of operational leverage in our business. We just have to keep adding investment teams, portfolio management teams. So this is where you can go astray. Back to your question, these are the challenges for the GP. How do you do all of that when you're under pressure to grow? But you just have to maintain that discipline and that focus on the outcome for your clients.
Is the solution in your mind adding other products or other strategies to the platform so that you can expand that way without getting into some of the issues that you mentioned around growing certain funds too fast, where you then have to get into the deployment challenge of deploying that capital quickly, maybe in a not a great vintage, or you run the risk of maybe making worse investments as a result of the investable universe being so finite? How do you think about that aspect of things?
Great question. That's definitely one of the trends where it makes sense and where you have a core competency as a manager. You will offer new evergreen funds. You may have started with a diversified fund, but clients, as they mature, as they appreciate the precision that they can have in building their portfolios, they may want those discrete solutions. We are doing that. Other managers are doing that, providing more specific exposures in the evergreen solution. Again, where you can be diversified and have scale. And that will, I think, provide the opportunity for firms to continue to grow and alleviate some of that product specific pressure that you may have. That's certainly one of the trends out there. No surprise, right? We've seen this movie before. If you look at the evolution of the mutual fund market, the ETF market, no surprise that you'll see new products, more specific strategies in those products, and no surprise that those clients that you've served well will want more from you and they'll want to do more with individual managers. This is exactly what we've seen before in other parts of the industry. It's exactly what's happening now with private markets.
On that point as well, do you think that certain strategies, let's take private equity or maybe infrastructure, even real estate as examples, potentially those strategies, companies or operators may choose to stay private longer by virtue of going with an evergreen structure and maybe even consume more capital as well? So even if evergreen funds get larger, there still may be enough investable opportunities at maybe even larger scale. Is that something that you're seeing as well?
I say this thing, and some people laugh, some sneer, but I say life is too short for capital calls. That's one of my little sayings around the office. And I think what we hear from our management teams of our portfolio companies, many of them say, okay, Rob, life's too short from capital calls. That's your world. Our world is life is too short to be public. That's what we see driving the investable universe for us. And back to our earlier discussion about some of the white papers that we put together, we talked about translating IRRs into time weighted returns. We spent a good deal of time, I don't know, 4 or 5 years ago, just looking at the market. It's pretty staggering. And a lot of the end clients, they get it because many of them are business owners. But 87% of 100 million revenue and above companies in the US are private. And when you talk to those management teams, and I appreciate I'm generalizing a bit here, they'll say, you know what I need is a partner. I need a partner to help me execute my mission. This is my industry. This is my company. This is what I need to do over the next 3, 5, 7, 10 years. This is what I need as a management team. This is what my people need. This is what my family needs. And I need a partner. I need a private equity firm like Partners Group to help us execute the mission. What I don't really need is to go public and have to deal with the challenges, the noise of being public. What it used to be was you'd have to make that trade off because there wasn't a private equity firm that could help you grow. You had to go public. You don't have to go public any longer. Of course, you'll still see IPOs and some companies belong in the public markets, but we just see this driving private markets. So I'm not worried about the big total addressable market because of this movement from public to private. That's not changing. I don't worry about that one bit. And then I think about, okay, evergreen funds, commingled funds. I just feel like we, the evergreen fund manager, the evergreen fund structure, taking away some share from some of those strategies that you've accessed through commingled funds.
something you just said, I think is really important to drill deeper on, which is private companies are staying private longer. Management teams want that. There's now capital to support that. That means, in many respects, the individual investor, at least historically until now, this explosion of both infrastructure solutions as well as innovation in products like evergreens now enable the wealth channel to get access to private markets in a way they didn't have before. Because if they weren't invested in private markets, they were missing out on all of this growth. So now they have that, in large part due to structures like evergreens. They can access these companies that now, to your point, may stay private for even longer. That's great. Then the question becomes, okay, so they invest, but how do they get liquidity? That's been one of the benefits of public markets. There are some structures around liquidity and features around liquidity in evergreen funds, but that seems to be one of the big questions on people's minds is, okay, it's great that you can compound your capital over time, but people have life events as individuals. They have needs for their capital. What is the liquidity solution for them?
I would say that the first thing that comes to mind is the positioning of these funds. If you were to look at our attempt at having a killer sales slide, it doesn't mention liquidity. This is about getting invested, staying invested, compounding. It's not about alchemy. It's not about saying, okay, we can take this inherently illiquid asset class and miraculously make it liquid. No, these are evergreen funds, and the manager should be developing a liquidity policy structure that is compatible with the underlying portfolio. When we started working on this in the US in 2007, that's why we settled on a tender offer fund. We felt like that's the right setup given our investment capabilities, where we can buy companies, we can do co investments, we can do some credit and shorten up the cash flows through the credit side. We can hold a little bit of cash. Most importantly, have a direct orientation. What you do not want to do with these evergreen funds is to have a focus on fund commitments. And maybe I'm stating the obvious, but if you want to have a solution that is invested and then it has a chance of providing liquidity, if you're just buying funds or committing to funds, that's exactly the wrong thing to do. Because if you want to get invested, you're going to have to run some sort of an overcommitment strategy, which is expensive and has risks. So direct is the way to do it. You have to grow in the right way so that the companies that you bought 4, 5, 6 years ago, you're selling now. The financings that you did 2 or 3 years ago, they're getting refinanced. So you can build up this natural level of distributions over time. That's how we think about it. That's how we've built our programs. That's why we like the tender offer, 5% quarterly tender, for example, because we can, with our investment engine, build up a pretty regular series of distributions. And then with the discipline and the diversification, have an ability to manage the variability of those underlying distributions, the variability of your client inflows, so that you can provide that liquidity. So a couple more things. Ours is a RIC, so we have to distribute, just like a mutual fund, a significant amount of our realized gains. It's a total return fund, our flagship, but they get an annual cash distribution should they want it. But most importantly, we're just so grateful and proud of what we've done in the ultimate net promoter score. For us, we've never come close to that, any one of our 5% quarterly tenders. I think that's just due to everything I've said, positioning the fund correctly, not growing too quickly, focusing on a specific set of clients, having as best of a quality and diversified portfolio as you can, and you put it all together, you can provide the experience for the client in terms of the client service experience, the investment result experience, that they want to stay with the fund and continue to compound.
What do you think would happen if there were to be a scenario where many LPs wanted to redeem all at the same time? For whatever reason, it was a tough market, a lot of people needed liquidity. What would happen in a case like that? Because I don't think we've really seen that in many cases in the evergreen space to date.
You've seen it in other evergreen markets. One takeaway I have is the benefit of control. Back to portfolio construction. If you have control meaning if you have the ability to go out and build your own content, make your content, be a lead investor, control investor, that really should be an important part of your strategy because that not only helps you get the money in the ground with precision, again, back to that sort of, I call it the portfolio management equation. This is my attempt at an equal sign if anyone's watching. On one side of the equation, you have your client inflows and your distributions off of the existing portfolio, and the other is your investment pipeline. And it really helps if you have control over that investment pipeline. It really helps if you're out getting the content yourself rather than waiting for it to come to you. But if you can get it yourself, very crudely, if you can manufacture that content and do that consistently through time, that's how you get these funds invested. And at the same time, to your question, if you ever needed to generate liquidity as a control investor, you can actually do that. And so I think that's what we have seen in other, parts of the evergreen private markets. You've seen those managers that actually own the assets and they have the decision making authority to go sell those assets. They can do it and they can manage through those periods of volatility, providing that liquidity in a way that you wouldn't be able to do if, again, you were sort of a passive manager of a portfolio, if you just had a fund portfolio, or if you just had a co-investment portfolio without the governance rights to be able to sell those assets. So that control element, I think, is an important one. But it gets back to positioning, disciplined growth, investor-based diversification. I haven't mentioned that yet. That's a critical one. That comes from disciplined growth. You want to have a diversified investor base across many different dimensions in terms of your platform partners and also just the underlying number of investors that you have. That's what I think about. That's what all of the managers should be thinking about. How can I build this resilient solution? And I think it starts with that positioning to the client. This isn't a liquid investment. Apply the same time horizon you would have the commingled fund to this, but you have the ability to get invested, stay invested, compound.
On that point, are there specific investment strategies, let's say private equity, private credit, real estate, infrastructure, sports, venture, whatever, all the different strategies that best fit an evergreen structure?
I think it's one that you can provide in a diversified format. I just look at how we typically run these portfolios. Our top 10 investments tend to be somewhere between 15 and 18% of the fund size. We just think that's the right amount of diversification. You're mitigating that risk, but you're not overly diluting yourself. I think that's probably the number one thing we look at. The other is, and this is maybe more of a commercial consideration, but it's, do you have aspirations as a firm in terms of how large of the pool of capital, how large you want that discrete evergreen fund to be? And that's a question I've never been able to answer because we get asked, oh, how large is this fund going to be? I say, I don't know. It's going to be larger. I care about the rate of growth. I care about the journey. That's what our focus is. I think some of those strategies you mentioned are compatible. Credit clearly, because you have the ability to build a wonderfully diversified portfolio. You can do that at scale. And you can do that through time. If you have a diversified credit capability, that certainly makes sense. GP stakes, I think that makes sense. But when you get too specific, if someone says, I just want California headquartered venture capital growth equity, that's probably a little too narrow. And I think the important context is when I say evergreen, I mean it's available for purchase at some regular interval, monthly typically. All of those attributes, getting invested monthly, always on the shelf. You can have an evergreen solution and maybe a less scalable strategy with the understanding with your clients that maybe you'll have to soft close. To me, this is just our bias, that gets away with one of the key attributes, which is that the funds are always available for purchase. But if you eliminate some of those attributes, loosen those constraints, you obviously have the ability to incorporate a wider universe of strategies into an evergreen solution.
So I want to touch on something you just shared, which is kind of this recurring interval for purchase. Our friend Nick Veronis at iCapital has said, and I'm sure others in the industry have said too, that private equity is sold, not bought. What do you think will make evergreens, bought, not sold? Because I do think, especially if it's available to the individual wealth investor, there should be a way to see all the different evergreen funds. And the Stanger report has some of the data and ratings, et cetera, returns. But how do we make it easy as an industry to go from sold, not bought, particularly with evergreens, which feel like a type of investment product that could be bought rather than sold?
Couple of things. What I've observed is that in the past 5 years, certainly, the industry is speaking more with a common voice around some of these topics. We don't have perfectly homogeneous fund structure universe, which I think the ETF market clearly benefits from. Mutual funds, they're all largely the same. If you look at evergreen funds, you still have some heterogeneity. You have interval funds, you have tender offer funds, you have some others that aren't 40 Act, and that creates a little bit of a challenge because people are just saying, okay, what is evergreen? But I think what we've done well as an industry, we're starting to all say the same thing, which is it's about getting invested. If I look at private equity, yes, if you have perfect market timing can help you. Is this year a better vintage than another year? Maybe, maybe not. What's more important, however, is just getting invested. It's hard not to have a positive return. If I look at any of the vintage years in private equity for 30 years, the lesson to me is you need the exposure. I think that is an area where the industry is singing from the same hymnal, if I may. This prior discussion about time weighted returns compared to IRRs, I think we have a really growing common voice there. So I think the industry just needs to continue the good collaboration that we've had in how we speak about these solutions. Liquidity is the other one. Let's not call these liquid solutions. I despise semi liquid. 10 years ago, I said to the team here at Partners Group, let's bury this term semi liquid. This is evergreen. That's how we should be thinking about this because, again, the most important thing for our clients is that they have the exposure and the time in the market. Let's position them correctly. Let's work as an industry together to tackle some of these educational points. And I think if you do that and then you combine that with just the outcome, the results over time, I think it will transition towards the state that Nick and I think everyone else would like to see.
On that point as well, how do you think about the interplay between evergreens and closed end funds? How do you think people should think about constructing a portfolio of both and where do they all fit in together?
I think the foundation, the core, should be evergreen. And if we're talking about the end client or the financial advisor, it's just a really compelling solution. You have to find the right manager, find the one with the experience, the right capabilities. Again, that's a bit of the challenge because you've had this frenzy out there of new solutions and they all look a little bit different. But the core should really be that diversified solution. And again, this is where this sort of the installed base problem we have because this idea, anything worth doing, it must be hard, no pain, no gain. Not really. And also this idea that these private equity funds have to be about the really cool cocktail party chatter. Not really. There's an element of boring is beautiful here. Get invested, stay invested, avoid the mistakes. That should be the core. That's our strong view here. And that doesn't mean there's not a place for commingled funds. Absolutely not. You have to have the ability to get those exposures that maybe you're not getting through your core evergreen fund manager, because again, not everything belongs in an evergreen format. And so I think a harmonious state that will evolve here, core, satellite, and I don't know what the right analogy is with traditional investing, but I look at my public equity portfolio. I've got my core sort of index funds, my ETFs, and then maybe I'll have a common stock here or there that I tactically want to get exposure to. Maybe that's how you would think about core satellite evergreen drawdown funds. Here's my core. And then tactically, I want to get this exposure, and I'm certain that the manager will be able to get that exposure in the next year or two before that opportunity goes away. Okay, let's do that.
On that point, how can the industry go about creating these asset allocation frameworks for investors? Maybe it's model portfolios. Obviously, iCapital came out with their version of a model portfolio, the IMAP. How do you think that evolves to help people understand, okay, I should have core satellite, maybe some tactical exposure, and here's how I can do it in a framework, and that becomes the way to do it?
The way I think about that broadly, we as an industry need to continue to innovate and make it even simpler. I think these evergreen funds have been a terrific innovation. It's provided outcomes with simplicity. That's the value proposition we provide to our investors. We're taking away all of that pain. We're providing you with a really effective, resilient solution. But we need to do more. So when I think about more and what the industry has been working on, the remaining pain points on the operational side, on the TA side, there's been a lot of emphasis on how we can do things better there. We did the first tokenization of a fund a bunch of years ago in Singapore. Some other managers have been really embracing that the last couple of years. I think that's a way to simplify and take unnecessary pain and cost out of the system. I think this implementation guidance that you're getting at, that's another area where the industry needs to work together and provide not just the guidance, but I think the desired end state. I see it happening now is to have an investable model framework, different choice, different models, but not just guidance, but actionable, investable, single subdoc. That would be really powerful. Complicated, really hard to do, but I think that's one way, Michael. I think you're right, where you would continue to see some evolution here to make what has become a easier part of the market to access even easier, whether that's from the end client perspective or the financial advisor. Maybe not easier for the GP or the home office of some of the wires or the important technology platform providers out there. But I think that's what we need to get to. And then you can really start to hammer at some of these untapped areas where there's demand. The defined contribution space, we've been working at that for over a decade together with the industry. Again, that's what's great about this part of the market. There's so much for everyone to do. It's easy to collaborate. That's what I love about the private wealth, among other things. It facilitates industry collaboration because there's a lot for everyone to do. But these are some of the things that I think we need to tackle in the next 12, 24, 36 months.
How do you think the industry can continue to educate the distribution professionals who are working with the advisors and their end clients on private markets, but also specifically evergreens?
Yeah, I wish there were some shortcuts here, but it really just gets to the point of sale. So we have a team here. We started with no team. We had our institutional business development sales team going out and going into the branches of the wires way back when. And then we added one person, one specialist, and we just grew organically from then. And now we have, I think, what most firms have. We have people out in different geographies, different territories, external, internal. We have home office teams, but there's no shortcut to having that highly educated professional engaging with the financial advisor. And highly educated means they not only know their firm's solution, but almost more importantly, they know how that fits within a portfolio. They know about the competitive landscape, the closest competitors, the broader set, and they can really help explain to those financial advisors how it all works and what are the opportunities, what are the risks. That's where we spend our time with our sales team. I joke we haven't had, I think in 20 years, one session on sales 101. How do you overcome objections? We don't do any of that. It's let's learn about recent investments that we've made. Let's learn about fund structures. Let's really be that empathetic resource to the advisor. And then, of course, collateral. We've talked a lot about that today in terms of the white papers and providing those concepts in a digestible format, not just regurgitating something you've done in the institutional landscape, but really building stuff from scratch that fits that financial advisor. And then finally, no shortcuts to just the human element, whether that's in the office or academies. Everyone's been doing a lot of work there. We did our first academy 14 years ago, bringing advisors in house. We like to do it in house and really give them an opportunity. I think most importantly, to do peer to peer networking. It's really powerful, just the advisors learning from others about the pitfalls, the opportunities. Okay, how do I now tell my clients about evergreen funds when they've been doing feeder funds for 10 years? How do I explain it? How do I talk about time weighted returns? All of that stuff. So it's a big focus. I think everyone's aware of that. I think we and others are trying to leverage any efficiencies where we can get them online, so to speak. But I just find there's no shortcut to that human interaction and relationship and listening to that advisor and helping them just better understand what's going on in the industry.
I think what you're getting at as well is this is very much a consultative sale. So is it hard to find the right type of salesperson for that type of role and mindset?
Yes. And at the risk of sharing the inside baseball or the dirty laundry, the last couple of years, we've had a big debate here at Partners Group. What's the right team size? People have said, rightly so, okay, is this like pharmaceutical sales 20 or 30 years ago? Do we just need a bunch of people out there? Or do we need, you said it, Michael, that consultative sale, that really educated salesperson helping? And we've stuck to the latter. You need to have experience. We have an outstanding team, not just in my opinion, but one of our big platform providers, they do all the analytics and they say, Rob, your team has the highest conversion rates, highest productivity. Why? How? And I say, it's laser focus on education and experience. We have built the team. We've done lateral hiring. We bring in alts experts who've been doing it for 10 years, 15 years. There's no substitute for that. And in this market environment where there's a great deal of anxiousness with all of our competitors to get out there and to grow, yeah, it's hard to find the right people. And I think it helps that we've been really disciplined. Our aspirations, of course, we want to grow, but we want to grow in the right way. So we just take our time and try to add the right people when we can find them.
What on your mind is the next evolution in private markets and wave of growth?
Outside of Evergreen, I think you've seen it. There's been tremendous growth on the credit side. I think the future, you've hit it a few times today. Infrastructure is a huge opportunity for the industry. You've seen a lot of success in the insurance space. I think the future will be defined contribution. It's taken a long time for a variety of reasons, but the application of evergreen technology to these large pools of capital, I think that's going to change. The implementation of these actionable models, that's going to be a growth area, no question. But I think, no surprise, the industry is looking at wealth, generally speaking, private wealth, defined contribution. That's a huge unmet opportunity. And what's most exciting, and this is what I love about private wealth in particular, you really make a difference. I mean, the impact you can have with the financial advisors, you're fundamentally making their practices stronger. You're helping their clients diversify. It's just so powerful. So we have this really powerful virtuous cycle right now. We've got great solutions, unmet need out there. And we've talked about the growth of private markets from that sort of management team, the entrepreneurial perspective. It's just a really exciting time, and that's not going to change. It's just years of opportunity to make a difference ahead of us.
That's awesome. And I think really exciting as we think about where this space heads. I want to ask final question, which I ask everyone on the show, a little bit different. What is your favorite or most interesting alternative investment?
My favorite is our U.S. flagship evergreen fund. If you could still call that alternative, and I say that again because the new traditional is private markets, private equity is the new traditional asset class, but hard for me not to say that. It's been my life's work. It's been sort of a fun family endeavor with my dad as a change agent. So Evergreen Private Equity Partners Group, that's my number one.
That's a great one because it shows the power of compounding. And look at what you've done over time as a firm. Incredibly impressive what you've done for the industry, what you've done for clients like your dad, like all of yourselves at Partners Group. So this was a fantastic exploration of the evolution of private markets, evergreen funds, and really what's to come in the space. So thanks, Rob, so much for coming on the podcast.
Thank you, Michael. Have a great day. Thanks.
Thanks. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going